Hello, and welcome to our video presentation of our Burkenroad's report on Conrad Industries Incorporated. My name is David Frzinski, and my fellow analysts are Chris Davis, John McCammon, Lauren Nelson, and John Paul Rodriguez. For this presentation, we will provide a brief overview of the shipbuilding and repair industry, an overview of Conrad's history and its products, give some peer analysis, explain our investment thesis, discuss some relevant risks, and describe our valuation methods and results. The United States shipbuilding and repair industry is composed of approximately 600 companies, with combined annual revenues of $21 billion. The industry is highly fragmented, with 50 companies accounting for 90% of total market share. The second tier, small to medium-sized vessel construction segment, requires high initial capital investments, high costs for technology, land, and property, plant, and equipment deter new companies from entering the segment. U.S. government spending is the main revenue driver of domestic shipbuilding and repair. A reduction in the defense budget, for example, could threaten production rates and could reduce the amount of bids and contracts awarded, increasing the intensity of competition for a limited amount of work. Conrad and its competitors are also vulnerable to decreases in demand because of oil and gas companies moving their drilling operations to regions outside of the Gulf Coast. Conrad Industries Incorporated was founded by J. Parker Conrad in 1948 in Morgan City, Louisiana. The company provides construction, repair, and conversion services for both steel and aluminum-hulled marine vessels. Conrad Industries is the parent holding company for 4 wholly owned subsidiaries: Conrad Shipyard LLC in Morgan City, Louisiana, Conrad Orange Shipyard Incorporated in Orange, Texas, Conrad Shipyard LLC, Amelia Deepwater in Amelia, Louisiana, and Conrad Aluminum LLC in Amelia, Louisiana. Conrad Orange Shipyard was added in 1997. Amelia Deepwater Shipyard was added in 2003. Conrad Aluminum Shipyard was added also in 2003. In June of 1998, the company completed its initial public offering of 2.1 million shares and became listed on the NASDAQ. However, in 2005, Conrad voluntarily delisted its common stock from NASDAQ and deregistered its common stock with the SEC under the Securities Exchange Act of 1934 because it had fewer than 300 shareholders of record. Following delisting and deregistering, the company's stock now trades in the over-the-counter market. After the addition of Conrad Deepwater, Conrad Industries has focused on upgrading or expanding the capabilities of its current facilities through capital expenditures, as opposed to adding additional shipyard locations. In 2010 and 2012, the Conrad board has authorized the company to repurchase up to $5 million worth of common stock. The 4 shipyards are built over a total of 79 acres and offer 230,000 square feet of enclosed area, designated for construction, repair, and conversion work. All 6 of Conrad's dry docks are at the Conrad Deepwater facility, where they can accommodate vessels as large as 500 feet in length. Each of the 4 shipyards is located less than 40 miles from the Gulf of Mexico. Through its acquisition and expansion of subsidiaries, Conrad has been able to increase the range of services offered to its clients. The company offers both new construction as well as repair and conversion services of both steel and aluminum-hulled vessels. Conrad also provides in-house engineering and design services and has a catalog of stock vessels from which it will construct during gaps in production capacity in anticipation of its clients' future needs. New construction contracts are obtained through a competitive bidding process with a fixed price. Most of Conrad's new construction clients are from the commercial sector, comprising 91.2% of construction backlog at the end of 2011. Moreover, new construction made up 80.6% of revenue in 2011. Conrad's new marine vessel project capabilities include deck cargo barges, tank barges, lift boats, towboats, ferries, offshore tugboats, and offshore supply vessels. Repair and conversion services are commonly provided on a time and materials basis, with an agreed-to labor rate and set margin on materials. A substantial portion of repair and conversion services are generated by the needs of the oil and gas offshore services industry and can fluctuate from year to year based upon the needs of this industry. Repair and conversion made up 19.4% of revenue in 2011. Since 2008, Conrad Industries has increased the percentage of revenues from commercial clients, reducing its dependence upon the offshore energy segment. This shift in customer base reflects the changing market in marine fabrication with changes in oil and gas prices. As illustrated in the graph on the left, Conrad's working capital has increased with increases in sales and changes in customer segments. Conrad has also self-financed its growth with equity, while also substantially reducing debt as shown in the graph on the right. This graph illustrates Conrad's stock price over the last 5 years. The price has since rebounded from the economic crisis of 2008 and has been steadily increasing since the lows of 2009. Conrad Industries' position in the marine vessel construction and repair market and the company's OTC trading create a challenge when trying to conduct a peer analysis. Many of Conrad's competitors are privately owned and thus financial information is not available. However, on the basis of recommendations from Conrad Industries' management team and from information obtained through Thomson One Banker, we selected Greenbrier Industries, Trinity Industries, Marine Products Corporation, Brunswick Corporation, and Gulf Island Fabrication as the companies to serve as the basis for a peer analysis. Greenbrier Industries operates mainly as a designer, manufacturer, and marketer of railroad equipment. A new and relatively smaller segment of its business is as a manufacturer of ocean-going barges to be sold in North America. Marine Products Corporation is a boat designer, manufacturer, and seller of recreational fiberglass powerboats, sport boats, deck boats, cruisers, sport yachts, and sport fishing vessels worldwide. Brunswick Corporation is a designer and manufacturer of recreational vessels worldwide. Trinity Industries is a manufacturer, leaser, and marketer of different products used in the commercial transportation industry, including rail cars and barges. The company also operates transportation services and insurance. Gulf Island Fabrication Incorporated, through its subsidiaries, is a fabricator of offshore drilling equipment used by exploration and production companies for the development of offshore hydrocarbons. The competitors' sizes vary with regard to market capitalization and sales, but we believe that these companies best articulate where Conrad Industries stands compared to its publicly traded peers. In terms of evaluating Conrad and its peers based on price to book, dividend yields, and return on equity, we believe that these companies are a solid standard. As the table shows, Conrad compares favorably to its competitors. Although Conrad Industries is the second smallest company in its peer group, Conrad has the second highest return on equity. Conrad has continued to grow through diversification while many of its peers have business segments that continue to decline. Conrad Industries' debt to equity is much lower than industry average, which is because Conrad has very little debt, whereas some of its peers have over 20% debt financing. Also, Conrad Industries' enterprise value to EBITDA and price to earnings are lower than industry average because of its large EBITDA in 2011 and large cash balance. Conrad Industries' price to earnings may be lower than Marine Products, Brunswick, and Gulf Island because of Conrad Industries' high earnings and limited liquidity. Conrad's market segment has both private and public companies that compete for work through bids. Success in the marine construction and repair industry requires companies to be mindful of the state of their customers' fleets and to have a good sense of what new vessels their customers will need next. Conrad's future opportunities are a function of several factors, including changes in demand based upon the political and economic climate and risks associated with the company's smaller size. To counter these threats, Conrad has several attributes such as financial stability, competitive product offerings, a diversified customer base, and capable leadership which bode well for the company. There are uncertainties about the upcoming fiscal cliff, a combination of tax increases and budget cuts set to automatically take effect at the end of 2012. In addition, uncertainties surround the credit markets and fluctuating steel prices. Until these political and economic uncertainties are determined, future demand for Conrad's products and services may be hard to project. Over the last 5 years, Conrad has broadened its customer base for new vessels beyond those involved in the energy sector in the Gulf of Mexico. We expect this successful strategy to continue. Conrad's future growth prospects consist of the expansion of the green energy sector, increased natural gas production, increased small to medium-sized vessel traffic in the Gulf of Mexico because of the Panama Canal expansion, and modernization of the Army and Navy fleets. We also expect that Conrad will expand the stock vessel program into new types of vessels to accommodate changes in customer needs. Year-over-year increases in revenue since 2008, in addition to prudent money management, have afforded Conrad a healthy balance sheet. In June 2012, Conrad had roughly $33 million in cash. The company is positioned to endure ebbs and flows in its business cycle and is able to self-finance capital expenditures and avoid a large debt load. Conrad also offers a diverse product mix, including both steel and aluminum capabilities. From its long-standing history in the region, the company has been able to develop key relationships with clients that have led to repeat business. To meet future growth prospects, Conrad's management budgeted $20 million in capital expenditures for 2012. The company's management expects that this historically high outlay will satisfy Conrad's development requirements for the foreseeable future. The expenditures include increased dry dock capacity, additional waterfront property, and shipyard redevelopment. Conrad's longevity and relative success is due to the company's ability to adjust to market shifts and capitalize on new sources of revenue. Stock vessel construction, for example, has allowed the company to maintain levels of production when bid work is low. Loss of the company's labor force is a risk that, if realized, could lead to decreased profits. Diversification of the company's client base into industries other than oil and gas have hedged volatility in Conrad's revenues. An economic downturn can have immediate effects on the company. Work at Conrad is a balancing act between stock vessels based on forecasted customer needs and awarded contracts. Conrad's business is also exposed to cyclicality and changes in environmental regulations. Conrad's smaller size increases the exposure to these risks. The market segment in which Conrad Industries competes has operational risks related to competition, weather, customers, labor, and materials. Conrad is also affected by macroeconomic factors, including the U.S. and global economies, and commodity prices. Economic downturns lead to decreased demand for Conrad's services. Marine fabrication is a capital-intensive business. Most of Conrad Industries' financial risks are related to capital allocation. Regulatory risks that face the company are not only those directly imposed upon it, but also those that affect its customer base. Our valuation of Conrad Industries projects a 12-month target price of $19, which gives Conrad Industries a market perform rating. Our forecast for Conrad projects that sales will steadily increase over the next 3 years, with a slight reduction in cost of sales as a percentage of sales, because Conrad will benefit from certain economies of scale and increases in margins from increases in demands for their services. We arrive at our target price weighting 3 valuation methods, including the discounted cash flow of owner's earnings, enterprise value to sales, and price to earnings. Using the discounted cash flow method, we calculated a target price of $22.57. Although we calculated a WACC of only 7.27% for Conrad, we included a liquidity risk premium of 8%. We believe that the added liquidity risk premium creates a more realistic discount rate for Conrad. Also, we speculate that the 7.27% discount rate is artificially low due to Conrad's low beta of 0.78. The inclusion of the liquidity risk premium is especially prudent due to the company's low trading volume. The low trading volume creates a low correlation to the market, even though the fundamental business is related to the overall macroeconomic performance. Because of a lack of publicly traded comparable competitors, we calculated our enterprise value to sales and PE ratios based upon Conrad's past financial data. For our calculations, we used years that we believed reflected the company's current capacity, backlog, performance, and overall market outlook. We selected enterprise value to sales and price to earnings because we believe that they accurately reflect the value of the company. Enterprise value to sales takes into account the company's performance in the form of sales. With the enterprise value to sales method, we got an expected target price of $17.48. Using the price to earnings method, we got a target price of $18.73. Conrad has a low price to earnings ratio compared to the market. The PE ratio has been stable over the last 5 years, averaging a multiple of about 5 times PE. Conrad's low PE reflects the earnings premium investors require for a stock with such limited liquidity. Additionally, we analyzed other ratios. However, we excluded all outliers from those ratios that did not reflect the core business of Conrad. By equally weighting the 3 methods, we arrive at our 12-month target price of $19. On behalf of my fellow analysts, I would like to thank you for watching the video presentation of our Burkenroad report on Conrad Industries. The Burkenroad reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.